Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
You know, even though we're in the dog days of summer now, there is no shortage of top stock picks from our equity strategists. I have Shiraz Mian here, our research director, next to me at the desk. And joining us via Skype is Dave Boren. He's got an interesting stock for you to consider as well. Shiraz, we're going to start with you, J.P. Morgan.
Yes, it is also interesting.
Yes.
It may not be as exciting as Dave's, but the reason I like J.P. Morgan is that it is an excellent play if you are one of those investors, as I am, who doesn't believe or doesn't buy into this, the sky is falling, we are on the cusp of a recession type of narrative.
Okay, but there is international trade exposure here.
It is not as much as you would have a 3M, a Caterpillar, but the exposure that personally I was surprised when I saw in the June quarter earnings results when J.P. Morgan and a number of its peers explained why the loan portfolios weren't growing as much as many in the market had been expecting. They said part of the reason is that these companies are tentative, uncertain, and not really spending as much because of this trade tariff overhang. So yes, there is exposure. Mm-hmm. But on balance, this is a very well-run company, very well capitalized. The balance sheet is about as good as any other bank has ever been in the recent past. In the recent past, I mean over the last few decades. The stock has been trading in this 108 to 116 kind of a range. It's currently at the bottom end of that range. And that makes me think that even though I like it as a long-term investment, I think even the trading-oriented of our audience may also benefit from J.P. Morgan. If you have even a modest improvement in risk appetites in the market, this stock will very quickly recoup this 6, 7, 8% ground it has lost and go back to 115, 116. For long-term folks, it's an excellent exposure to the finance sector. Even with all of this interest rate overhang, even with all of these macro worries, the stock is up more than 10% this year, though it has lagged the broader market. But it is an excellent way to get exposure, gives you a flavor of all the different finance sector spaces, consumer banking, investment banking, and also asset management. Valuation is reasonable. It's not dirt cheap, but it's definitely not expensive. Pays a very good dividend in an environment when the 10-year yield is yielding less than 2%. This pays a growing dividend that's 3.25%. So all in all, an excellent play, both for short-term folks as well as a long-term investment.
And it's a buy rated, right?
It's a hold rated.
It's a hold.
That's
okay.
right.
So if I'm the viewer, I'm saying, well, it's just a hold. Should I be acquiring this?
So that's why I'm recommending it, that even though the earnings outlook for J.P. Morgan isn't as exciting as a Zacks rank #1 stock should be, but it's an anchor, stable stock company with very limited downside risk and both an immediate upside. If some of these immediate fears ease, it could very easily go back to the top end of its recent range. And for long-term folks, plenty of positive attributes. I expect significant gains for the stock for long-term. So yes, it is not a rank 1 or 2. It doesn't have the earnings estimate revisions momentum as many other stocks have, but it's an excellent long-term investment.
All right, Dave, you have Interactive Corp, right?
I do.
Company that's outpacing the market here?
Yeah, by a pretty wide margin, basically double of the S&P so far this year. And I have a trade-related angle to my pick as well today. Obviously, the financial news lately has been dominated by trade disputes between the U.S. and China and the imposition of tariffs and the like. And it's when you look at companies, it's very, very rare to find a company that sells physical goods that doesn't either buy something from or sell something to China. And even the companies that appear to be fairly insulated, if you look 1 or 2 levels deeper to who are their suppliers and who are their customers, the China exposure is really everywhere, all over the market. And so I'm looking at a company that basically has almost no exposure at all to Asia. So first of all, they don't deal in any sort of physical goods. So there's no tariff issue at all. And second, Interactive, which is a conglomerate, and I'm going to come back to the word conglomerate in a minute, but a conglomerate of internet businesses has about 45% of their business in North America and the remainder international, but it's mostly Europe. There's very, very little Chinese business, and there's no dealing with they don't deal at all with physical goods that are subject to tariffs or the like. Right now, Interactive's 2 biggest categories of business are dating services and social services. So they own they own 80% of the Match group, which includes Match, Tinder, OkCupid, the most popular dating sites, and then also home services. So they purchased Angie's List a while back, and they've built Angie's List and their other home services business to be the one-stop shopping for anybody that needs home improvement, repairs, and the like. In corporate finance, managers basically, it's very formulaic, right? Managers can plug in the numbers and say, yes, it makes sense for us to hire. Yes, it makes sense for us to make new purchases. It makes sense for us to launch a new product line. They just need to know what the numbers are. And the trade war throws a lot of uncertainty into their calculations because they just don't know what the tariffs are going to be. So this is a business that has nothing to do with anything that comes from or goes to China. So that's comforting. It's also a Zacks ranked #1. Earnings have been great. They just put out a beat last week, and along with a big earnings beat, about a 27% beat on the bottom line, they also announced that they are considering at least spinning off the Match business and/or the Angie's business. Now, this is not unpredictable because they've done this before. They spun off LendingTree in 2007. They spun off LendingTree. They spun off Home Shopping Network, and they spun off Ticketmaster. So we've seen a shift in the market away from these conglomerate businesses, like GE is obviously the most obvious example, of a business where they're divesting lower performing assets and trying to get back to their core. IAC is built differently. They intend to spin off businesses. They start them, they acquired ancillary businesses that fit in with what they're already doing, and then once they're mature and ready to go, they spin them off to shareholders and unlock the value of new assets where the sum is greater than the parts. So I love the idea that they have these successful businesses. They're going to spin them off, give away the assets to shareholders for free. It's like a free call on the performance of these really well-performing businesses, and as a shareholder, you get it for free.
And as you said, no trade concerns. Kind of unique to hear a company without trade concerns these days.
It's getting increasingly rare.
Do you own either of these 2 stocks, Dave?
No, Terry, I don't.
Okay, and what about you? Do you own either of these?
I have JP Morgan in the focus list portfolio.
Okay. Well, thank you both for the information. Don't forget, there is always more stock information. As we always tell you, it's on our website, Zacks.com, and all you need to do to begin accessing it is get on over to the homepage. With Shiraz and Dave, I'm Terry Ruffalo.